Hello, class. Hope you're having a good evening tonight. I certainly am. I thought in this brief video tonight we'd talk about balance of payments, which is a topic in international economics. Um, there's quite a bit in the news, a lot about every day, really, in the financial press about trade. And you hear the terms balance of trade and trade surplus and um, current account balances and those sorts of things. Those terms are used in the press. And it's a few of some other terms we'll use tonight that are commonly, let's see, misunderstood, I guess, in the press. We'll give a little more precise definition of some of those terms as we look at the accounts that make up what's called the balance of payments. And in particular, we'll be looking at the export and the import of goods and services. We all know we export fewer goods and services to China than China exports to the US. And so you hear a lot said in the press about what's called a balance of trade deficit. So we'll talk about the terms deficit and surplus um, as it relates to balance of payments. We'll also use the terms debit and credit and so forth. So if you have an accounting background, I would just say here, first off, that it's easy to get a little confused because you learn a certain way of looking at transactions with debits and credits, T accounts, and so forth, in financial and also managerial accounting. And that your understanding, which is hopefully if you did the first course in accounting, we don't assume that here for this class, but if you did, you have hopefully a correct notion of what the word debit means, and credit really just means left and right. It's really, that comes from the Latin debere and credit. Forget, but debere is left and right. So we talk about T accounts, and doesn't necessarily mean good or bad for anybody. Okay. We're accustomed to the average person out there on the street, though, when they hear the word credit, that makes them smile, right? Because they were told the other day that the bank accredited their account, perhaps with a deposit from a customer or something. And so credits tend to be viewed by average people as good things and debits as bad things, but people don't really understand what they're talking about. And from the bank's point of view, though, they look at your checking account as a liability, and actually from the bank's point of view, a credit, if they credit your account, I guess is arguably a bad thing. What's good for you is kind of bad for the bank, I suppose, uh, because they increase the liability. But at any rate, I digress there a little bit. I just want to say that for you accountants out there, bear with us, because my approach here in presenting balance of payments is to take as simple of an approach as I can, with a language that's consistent with how economists, alas, and other people in the financial press use these terms, debit and credit and deficit and surplus and so forth. Okay. So we first off, with the balance of payments, we have several accounts that are associated with that, and each of these accounts have transactions involved. So we're going to talk first about goods and services and so forth. When a company in the United States maybe makes an automobile and exports that automobile to Europe, okay, there's a transaction there. So you have value that goes one way, the automobile itself, which is inventory, yeah, merchandise inventory. And it goes from the US to Europe. And then in the other way, the other part of the transaction is there's a payment that goes the other way. So let's sketch that out, and then let's look at how we would use these terms, surplus and deficit and credit and debit and so forth. So you got the US here, okay, kind of a bad picture of the US, I suppose, but they ship a car. Here's the car to France, okay, so here's France and here's the US. Now, somewhere along the way, there's a payment made in dollars. So it could be originally in euros, certainly, by the French citizen may purchase the car in euros or somewhere, but it's going to be converted to dollars. So that the merchant in the United States who sold the automobile here is going to receive at some point the final payment here in dollars. And so we're going to call this type of transaction, which is really an export, right? This is, we're exporting an automobile. This is export of a good. You also can export services as well. We're going to call this a credit, okay? A credit. Okay, we're just going to call that a credit. I'm not going to say too much about T accounts and so forth, but there's a exchange of assets here for the merchant in the U.S. Actually, for those accountants here, you realize that the cash asset increases, inventory asset decreases. And we're going to call that inventory asset a good, a tradable good. Okay, so really there's an exchange between assets here, but we're going to use the symbol plus here to designate that there's cash coming into the U.S. or an account receivable. Okay, so there's some sort of payment. Okay, a payment is received by the U.S. So we're going to, in fact, in all of our discussion, we're going to make reference to us as American citizens living in the U.S. So there's this payment received, okay, by the home country, in exchange for what? For some sort of good or services, something of value, for value uh, that flows out of the country. Okay, so there's this car flows out of the country, has value. When we receive cash payment in the U.S., we call this a credit. Okay, this is a credit transaction. In the text here that I'm referring to for our class, it says a credit transaction is one that results in the receipt of a payment from foreigners. And by convention, credit items are recorded with a plus sign. Okay, so this would be a credit. Whereas a debit, as you might imagine, we'll use a debit for a minus sign and with a minus sign. And that may refer to an import, right? Where you have the opposite here. And a payment here is made, is made, or it goes out by the home country, so to the foreign country for a value inflow. Okay, for a value inflow. So I could draw the picture here, but I think you get the picture here. You just reverse the arrows here. So this is debits and credits. So let's look at some examples here. Whoops, some examples here. So suppose, by way of example here, someone in the United States purchases, say, $8 million of, okay, I like you talking about French wine. Okay, French wine or something like that. So we purchased $8 million of French wine. So this is an import to the U.S. So would this be a debit or a credit here? Well, what would we call this transaction really? If you purchase $10 million or $8 million of French wine, then the value's coming in, the dollars are flowing out, right? So this is a debit transaction. Okay, so this is a debit transaction. And so in the balance of payments accounts, as we look at this, we're going to use a negative sign, and we're going to say that the current there's a negative outflow here of dollars from the U.S. to pay for the wine that comes into the U.S. Suppose Europeans, okay, Europeans. Here's another example. Europeans purchase or import. We could use the words export. This is here we're importing here into the U.S. Here Europeans are importing, so Americans would be exporting. So Europeans purchase $5 million, okay, of U.S. corporate bonds. Okay, corporate bonds. Does that make sense? Corporate bonds. So in this case, Europeans purchase, so the bonds are leaving the US to go to Europe. Europe is going to pay with cash. Cash is going in. So this is a credit transaction, right? From the point of view of the US, credit transaction. Okay. And so we would use a plus here. Okay. There's actually two accounts. We're using, though, you got to be careful. We're actually using uh, double entry bookkeeping. That's what this is called, double entry bookkeeping. And okay, for the benefit of those who, want to understand this from an accounting perspective, let's think about this just a second. Say, first off, the U.S. purchases $8 million of French wine. Okay, that was our first example here. This really two accounts for the U.S. If you think about the U.S. winemaker, okay, or wine manufacturer, they have two accounts going on here. Okay, so they have two asset accounts, really. They have, say, the cash account or accounts receivable. Doesn't matter. We could use cash or accounts receivable, which is an asset account. And then they have merchandise inventory, which these bottles of wine. Okay. Now let's see here. Got to be careful. This is the French winemaker. Okay, so this is it that made the wine. So for the U.S. Wine distributor, how about that? Wine drinker or distributor. Let's look at it this way, because it was the company in France that made the wine. So this would be wine distributor here. So at any rate, they gave up. If you'll notice here again, our first example, they gave up $8 million. The U.S. company gave up $8 million. That would be recorded with a credit, 8 million to the cash account. And we gained merchandise here of $8 million in French wine. That would be a debit. Now, those of you who have not had accounting would not understand this, but this is a double entry bookkeeping device here. You have T accounts, and the way you would journalize this, the U.S. company that going to distribute the wine would record this transaction in a journal entry where they would debit merchandise inventory and credit cash for this amount, okay, for $8 million, okay, on this date and so forth. Now, this may not mean anything to some of you, and that's fine if you haven't learned about T accounts and so forth. I mention this here, though, because everything we learn is really consistent with accounting. But when you hear this thing right here, debit transaction here, okay, debit transaction, referring to this U.S. importation of wine from France. Then the debit refers to the merchandise inventory account. Remember, debit means left. So even though, it's the cash account that gets credited, uh, but it's because cash leaves the United States and wine enters the United States, we use a debit for the merchandise inventory account. So this is a debit transaction. That's what we call it. Even though one account's debited, the other account's credited. So that can be confusing to accounting students. When we talk about a debit transaction, we're talking about not the cash account, but the other account. It could be asset account. Other debit transactions can refer to, debiting a liabilities account or a capital account. Those are, broadly speaking, your three balance sheet accounts. You also got revenue accounts, that is service accounts. But the cash account gets credited here in a debit transaction. That's the point. When you hear debit transaction, the cash account gets credited, but some other account gets debited. That's the point. So debit accounts or debit transactions. Debit transactions might involve a debit to another asset account like merchandise inventory. It could involve a debit to a liability account or a capital account. So let me just say it this way: debit transactions from the point of view of an American, say, involve increase in this case here, inventory or goods and services, goods, increase in services, can also involve a decrease in liabilities. Okay. But it will definitely involve a decrease in cash. Okay. Because cash is going out. So the decrease in cash is going to be paired with one of these. When I say cash, it could be accounts receivable. These will be debit transactions that we record with a negative sign. So we're importing here, right? When the U.S. imports goods and services, or we decrease our liabilities, okay? Maybe we make payment on something we owe to another country, okay, by delivering some cash. In that case, we'd be decreasing a liability. We may, U.S. auto distributor may owe Volkswagen in Germany or some country where there's some certain amount, some value there. And so we may export to them some cash. So cash goes one way to pay off a certain amount of a liability. So these are debit transactions. Credit transactions are the opposite. Okay. Credit transactions, again, are referred to or used with a plus. And that would involve, okay, an increase in cash, but correspondingly then a decrease in goods or services. Okay, decrease in one of those, or an increase in liabilities. Okay, or and then also an increase in cash. Okay, an increase in cash. Okay, so an example here again would be, when we export goods and services, we lose goods and services and we have cash come in. So exporting would be a credit transaction. Imports, okay, imports would be a debit transaction because we're importing that French wine, say, or we're importing some insurance or services from abroad and we pay with cash. Americans pay the foreigner with cash. So that would be a debit transaction. For most of us, what we hang on to here, though, is what's happening to the cash, okay? For the American citizen, the cash decreases. Use the term debit and a minus sign. If the cash increases or accounts receivable increases, use a credit term and a plus. That is not to say that the cash itself, the cash account itself is debited, okay? Here the cash account is actually credited, as I mentioned up here. Cash account's credited. A credit on a cash account means cash goes down. But if you haven't had accounting, you don't know that, okay? But at any rate, stick with this and you'll be fine. Those of you who have not had accounting, you can think of it in these terms. Okay, so that's the first part here in our discussion of balance of payments. Again, now we're going to look at transactions that involve the flow of value of various things back and forth across the border. And so whatever is of value flows one way, cash or accounts receivable or some sort of financial payment goes the other way, okay? And we have different accounts in which we record those things. And so we're going to use double entry bookkeeping. For every debit, there's a credit, okay? And let's just say that the sum of the debits has to equal the sum of the credits. As we looked here in this first example here, where we were um, importing wine, $8 million from France to the US. There was a debit to the merchandise inventory account and a credit to the cash account. Every debit has a credit. Those get recorded in different accounts, okay, and the balance of payments. And at the end of the year, end of the quarter, what have you, we can add up the debits, we can add up the credits, and they're equal. Okay, so it's just something to hang on to if you want. So let's look at what the balance of payments account is going to look at, or be. Let's look at what are called the components of the balance of payment account. Okay, so you have this thing on the right here. You got the CAB plus the FAB plus the OSB, okay, is equal to 0. Okay, so this is, we'll call the balance of payments identity, actually, but I'll just say equation here. Okay, but it's always true. You could actually write this thing here. It's like saying 2x plus x is 3x. Doesn't matter what x is, that equation would always balance. So this is always going to balance. Okay, this is called the current account balance. Okay, current account balance. So we're going to look at each of these in part. The current account balance, first off. Okay, this involves merchandise trade. Okay, in fact, that's a separate account. We talk about the merchandise trade balance here. It involves services trade. Okay, so we're going to call that the balance of that account, the services balance. And then it has a small, another account we could call the unilateral transfers account. Unilateral transfers. For instance, what might be in here, uh, unilateral transfers, might be the U.S. government transfers military hardware to one of its allies overseas or something like that. So this is the UTB. This is very small. So in general, we're going to say that the CAB is approximately equal to the sum of merchandise trade plus services trade. And each of those will have a balance. So using our sign convention we just had here right here, where if the money flows out or the value or the accounts receivable goes out, you're going to use negatives. Just think in terms of cash to make this simple here. If cash flows out, it's a debit transaction. There's a decrease in cash, or again, accounts receivable. Could be one of these two. A credit transaction involves an increase in cash. So here we have for these things here, if we indeed import $8 million of wine, then this would be a -8 would be a part of the merchandise trade balance. If we sell 100 or five, well, let's say $100 million of accounting services, that would be a services balance, and we sell that, okay, so that the cash is coming in, that would be reported as a plus 100 million, so forth. Okay, so at the end of the year, we can add those positive and negative transactions, those debits and credit transactions, and you're going to get a value here for the current account balance. Now, the current account balance does not have to equal to 0. It's part of something, though, that will equal to 0, but by itself, it need not uh, be equal to 0. So this is the current account balance. It's at the end of the year or end of the quarter, we can compute it. We add up the dollar values of these things, make sure that we attach the appropriate sign for each transaction. You'll have the current account balance. By the way, the services trade balance, the SB here, would include, say, expatriates living in the United States, say foreign nationals, maybe from Mexico or what have you. They work in the United States and they send some of their income back home to their wife and kids. Okay. That would be recorded here, by the way. Okay. So there would be an outflow of cash, if you will, from the US. And so that would be recorded. It's a negative here in the services trade. All right, so that's current account. We're talking primarily about goods and services. Okay, the idea here is goods and services. Services and goods, goods and services, and each will go one way, either out of the US or into the US, and cash, they will go the other way. Attach the appropriate sign and you'll be fine. Okay, let's go to the second component here. This is the financial account. Okay, it's really, this is where in the FAB, we record private financial transactions. This, when I say private, non-government, okay, or non-central bank transactions of assets. So you can, just as up here, we import and export goods and services. Here we will basically import and export assets. When I say assets, I'm talking not about merchandise assets and so forth. I'm talking about property, really, of some sort. It could be financial property and so forth. But we import and export assets. And this is in the private sector, okay, in the private sector. Finding that I have a hard time writing sometimes when I talk. I don't know why. But at any rate, import and export assets. Now we'll get to bank assets or central bank and government assets in a minute. But this is generally where we pay for the goods and services. This is where payment for goods and services, these two things up here, are made, okay? Uh, where payment are made, I guess I should say is made, okay? Ah, boy. But at any rate, so remember I talked here about this double entry bookkeeping here where we purchased U.S. American citizen, purchased French wine, gave up cash. There's really two accounts affected here. The merchandise account is an account that's in the current account balance. Okay, that's merchandise. But the payment for it, okay, is this account here. Maybe we paid cash or something like that, or accounts payable, something. So that payment is made in an account here in the financial account balance. Okay, so this is where payment is made for goods and services. So this is where basically assets are exchanged, and it could be financial assets, could just be currency, could be a check. Okay, checks are often written for things like French wine. Okay, in fact, it's more likely that the U.S. wine distributors can pay with a check than with a suitcase full of $100 bills, cash, right? So that account, which would still could be cash or cash equivalents, so forth, or the U.S. winemaker may not really pay any cash or write a check for that wine. They may instead purchase that wine on account. And so they've basically run up an account payable to the French wine grower or maker. Yes, grape grower, winemaker. At any rate, that account, whatever it is, if it's purchases made on account, that's recorded in a financial account balance. Okay, so this is where we pay for goods and services. And then, okay, we'll come back to these, okay? And then the last one here is the official settlements balance, okay? Let me write, make sure we got this here. This is financial account balance. So we'll go here now and talk about assets that are owned by the government and the central bank. Those are exchanged too in what's called the official settlements balance. And so we can call that the OSB. All right. So this, the term here for this last one here, this is government and central bank, government and or the central bank in the United States. The central bank is the Federal Reserve, and they have assets that they trade with foreign nationals on occasion. And these assets would include things like foreign currency reserves. Okay. Um, let's see here. Let me list them here. You might have convertible, what's called convertible foreign currency. Okay. So, if you got a current, some little fourth world country, no such thing, third world country, it prints its currency out on a Hewlett Packard printer. That's not included here, but euros, yen, pound sterling, those sorts of things, those currencies are convertible. Okay, you can exchange them for dollars or exchange dollars for those. So the Federal Reserve, primarily being the central bank of the U.S., has on its balance sheet, you can see lots of foreign currencies. And so that would be an asset. It may exchange for dollars, export those for dollars, or import in payment with dollars. Gold is another one. Okay, cool. Gold. You might have foreign bonds. Okay, foreign bonds that are denominated in a hard currency. When I say hard currency, that's the convertible currency. Okay, these two terms are used exchangeably. So these things we recognize, like euros and yen and so forth, those are hard currencies. And the fourth one is what are called special drawing rights at the International Monetary Fund. Okay, special drawing rights, and we usually just say SDRs, at the International Monetary Fund, the IMF. And really, what special drawing rights are is a basket of currencies. It's like a hypothetical unit of account that is a weighted average of the yen and the euro and the British pound and the dollar. They have weights on them. Okay, so that's what, and they weight these. The weights will change from time to time, but the weights are determined by the volume of exports and imports in those countries and so forth. Without getting into that, that's what a special drawing right at the International Monetary Fund is. So the Federal Reserve has all of these things, and they can export them or import, say, gold for dollars, just like at wine distributor in the U.S. Imported wine. Okay, the bank here, Federal Reserve, might import gold. How do you import gold? Well, they take gold to the gold exchange market. They buy gold. They can store gold. They can sell gold. The same sign convention is going to apply here in all of these, as a matter of fact. Okay, when we talk about transactions on the current account or on the financial account or the official settlements account. Okay, if you think of the dollars coming into the country, if they come into the country and the transaction, then we'll record it with a plus. If dollars go out, you'll record these with a minus. Okay, in these three areas. And so it turns out, because of the double entry bookkeeping process, every transaction will affect an account here and an account here, or maybe two offsetting accounts here, or two offsetting accounts here, or an account here, and an account here, and so forth. Because every debit has an equal credit in double entry bookkeeping, then this is an identity. That is, this thing will always equal to zero. And if it's not, then they throw in what's called a statistical discrepancy in here somewhere to make it equal to zero. But that's not a big deal for us. Okay. That's not something we really have to worry about. Okay. So, this is kind of the first part of the video here. I want us to, as you read through this in your book, you need to realize that there's a particular way of looking at these international transactions and a simplified approach that doesn't have the same, exactly, we don't necessarily have to refer to the same framework with T accounts, although we are, as accountants do. We use pluses and minuses. So plus, cash is coming in, that's a credit account, okay? We'll talk about a current account surplus or deficit. You hear those terms as well. Each of those three those accounts on the BOP equation can be running a surplus or a deficit. So a surplus means the cash is coming in. More cash came in than cash went out. So the credit, a plus, a surplus, all kind of correspond to each other there. Okay, cash inflow is greater than the cash outflow. And so what you see here is that because of that identity, if a country, say, runs a current account surplus, then it's likely, not necessarily, but it's likely to run a financial account deficit, okay? Or if there is a positive balance on the current account, there'll be if we're running a current account surplus, there'll be a positive balance on the current account. Then there'll be a negative balance on the financial account, probably. But you can't say that exactly because, again, there's three parts to that equation, right? The central bank might be intervening as well. But usually the central bank of the U.S. anyway is not, they don't buy and sell a whole lot of gold and SDRs and so forth. Central banks will get into exchanging their assets for dollars or sell those for dollars, exchange them. Dollars could go either way. They'll get active with these accounts if they want to manage somehow the exchange rate between the dollar and other currencies. We don't want to get into that here tonight. That's a topic for a later episode. So generally speaking, if the central bank doesn't do much, then the movement on the current account is offset by an equal but opposite movement on the financial account. So you hear a lot in the news about a current account deficit or with the of the United States with respect to China, say, or a trade deficit with China, which would be a component of the current account. We trade with other countries too, right? But what does that mean? That means that we import more from China than we export. That more dollars flow out to China than flow to the United States and so forth. If you think about that just a second, if that happens for any period of time, we import a lot more stuff, goods and services from China that we export, then they're building up dollars in China, right? So what are they going to do? I mean, China buys some U.S. goods, but not as much as Americans buy China. So on net, there's a buildup of dollars in China. Well, the Chinese take those dollars and they invest them in U.S. assets. So it may be financial assets. So they could buy corporate bonds and so forth. One thing they definitely do is they buy a great amount of treasury bonds. U.S. government debt is in the hands of the Chinese. And some people look at that. The Chinese own a lot of our debt, government debt, And since we're kind of adversaries a little bit, they look at that as a potential threat, actually a national security issue, that a good deal of our debt is in the hands of the Chinese. For after all, if the Chinese decided to quit taking our debt or quit buying U.S. government debt or try to dump it somehow in the markets, you would see interest rates in the United States shoot up. Okay, interest rates move opposite of the price of bonds and so forth. So U.S. government debt is viewed cheaply and of very little value on international markets because the Chinese are getting rid of their treasury bonds. They don't want treasury bonds anymore. That means that interest rates are going to go up in the U.S. So at minimum, there's a risk there, if you will, in running a persistent balance of trade deficit with your adversary, say the Chinese. We have balance of trade deficits with other countries and so forth. But with respect to the PRC, that say the People's Republic of China, we run a persistent deficit on the current account. Okay, on the current account, but it's offset with them. Okay, now that's not to say our whole current account runs a deficit, but we have a balance of trade deficit, I guess, with respect to China. But to offset that, the Chinese are buying lots of U.S. assets. So it turns out if you look at the United States balance of payments accounts for the last several years, the current account has been running a deficit and the financial account's been running a surplus. So, goods and services can go one way, and assets can go the other way. And if you're talking about the Chinese, again, one last time here, their goods are going this way to the U.S. We're buying more than we're selling to the Chinese. So lots of goods are coming into the U.S. So lots of assets are going out of the U.S. to China. Many of those assets are government debt. Okay, bonds. It's nice to have a bond, right? Maybe you've had a savings bond or something. That's an asset. Okay. The promise of our government to repay you with interest at some point in the future is for you an asset. But there are other assets, could be corporate bonds, or could be fixed assets, could be buildings and corporations and so forth, could be stocks and companies and so forth. So all that is recorded, though that asset exchange is recorded on the financial account balance. All right. So again, from year to year, quarter to quarter, you have movements in the balance of those accounts, but the account balances will always sum to zero. That is to say, the overall balance of payments is equal to zero, even though sometimes in the news you'll hear them say, you'll hear it said that the balance of payments is a surplus or a deficit. They're not really looking at all three components of that equation. They're neglecting one or two when they say that in the press. Overall, the sum of those three things has to equal zero. All right, so let me bring in one other thing. How does U.S. domestic behavior with respect to saving? Okay, or you can save, the government can save. The federal government never saves. But how is that affecting our balance of payments and so forth, especially the current account? So we're going to get to that. Let's go back to the camera here and mention something. Again, just to make sure we understand the balance of payments identity, when we write current account balance plus a financial account balance plus the official settlements balance is equal to zero, we can expand this out just a little bit by saying the current account balance is the merchandise trade balance plus the services balance. Of course, there was also the unilateral trade balance, but that's so small. So this is kind of an expanded form of the balance of payments account. Okay, so as one goes up, some other balances have to go down, and they go up and down with a sign convention if there's involving a a payment into the US, that's a plus. If there's a payment out from the US in cash or checks or whatever, that's going to be a negative. Okay. Now, again, this behavior of the current account in particular, exports and imports, is affected by savings and from the government and also from the private sector. Let's see how that works. Okay. Um, I mean, intuitively, perhaps it makes sense if we run a current account deficit, that is, we're importing more than we export. There's dollars leaving the US. That means we're not saving. Okay. We're not saving. There's dissaving. If you have a current account surplus, that is, the current account balance is positive, you're exporting more than you import, there's cash coming in on net, then you're saving in that case. You're not dissaving, but you're saving. So how can we really define this more strictly here? Okay, well, you might recall the gross domestic product equation here, or the national income accounting equation from your principles level course. National income is equal to national expenditures here. And we use this formula here to compute gross domestic product. And generally speaking, national income, there's a little difference, okay? I'm going to put a little squiggly here. There's a little difference between national income and expenditures, but it's not enough for us to worry about here, okay? So, but these accounts here are used to compute expenditures and total output of the U.S. economy. And so you have consumption, investment, government purchases, exports minus imports to get net imports. And remember, this minus imports here is an offset to imports that are part of consumption here. So that's why we subtract imports over here. It's because you added them here when you added up all your consumption receipts in the economy. Okay. There's more things we could say about this, but this should look familiar to you. Now, what can you do with your income? Okay. Also, your income will go in one of three places. Either you consume out of your income, or you save part of your income, or you pay taxes out of your income. Okay. So this is what you do with your income. So national income is equal to these two things. So I want to set these two things equal. The right-hand side, since the left-hand sides are equal, I'm going to set the right-hand sides equal here. And so this is C plus S plus T, and the C's drop out. And I'm going to isolate this thing here. This is your current account balance here. Exports minus imports is your current account balance. So I'm going to leave this over here. This is your CAB, current account balance, is equal to S minus I, savings minus investment in your economy, and T minus G, taxes minus government purchases. Okay, so this is the current account balance. It'll be positive. That is, you'll have a current account surplus if exports exceed imports. This will be positive if exports exceed imports. That is, you're a net exporter. And that'll happen if, at least one of these has to be positive here. If savings is greater than investment, or taxes, that's revenue received by the government, is greater than government purchases. So this is called private savings here, private savings. But private savings is in the private sector if savings exceeds investment, private savings. For the government, if they take in more than they spend, this is public savings, okay? Public savings. In your book, there's an identity similar to this, okay? So what you see is that, say, if the current account balance is positive, that is, you're a net exporter of goods and services, then either private savings or public savings has got to be greater than zero. One of the two, okay? One of the two got to be greater than zero. If neither are greater than zero, then you're necessarily an importer of goods and services, in which case you have a current account balance that's negative. Okay. So there's a relationship here between what's going on domestically in the way of savings and internationally here with respect to trade. And so you hear this referred to by politicians a lot. They'll say things like, make reference to the fact that the federal government never seems to save, okay? Never seems to save. They spend a lot more than they bring in. So necessarily, we're going to be an importer. We're going to have a current account deficit here. Of course, it could be offset by private savings. Private savings, that a lot of times can be negative as well. If these two things both, if as individuals we're not saving and the government we're not saving, then of course we'll be an importer of goods and services. What's happening there? If we're importing goods and services, then the balance is going to go this way. We have a current account deficit. If you have a current account deficit, then you're going to have a financial account surplus. Okay, that means you're exporting on the financial accounts. Is that good or bad? Well, that means you're selling assets to the rest of the world. Okay, and that could be fixed assets. Doesn't necessarily have to be U.S. Treasury bonds, which is disturbing enough, perhaps, that there are a lot of foreigners that have loaned money to the U.S. government. You realize a purchaser of a bond is a lender. Anyone who buys a bond is a lender. So when China has all these bonds, they've lent to the U.S. Well, guess what? A day of reckoning's coming. Okay, day of reckoning's coming. That is, those bonds have to be repaid somehow. And so that could be is viewed by some as even as a national security threat. And it's the result, perhaps, of profligate living, either in the public sector or the private sector here domestically, that causes us again to have a current account deficit, consequently a financial account surplus. We export more assets than we purchase because we're importing more goods and services than we purchase internationally. So all these are concepts you need to think about, if you will, in the reading of your book and so forth. I hope this is helpful. If there's any of this, though, you don't understand, be sure to let me know. And sometimes at this level, things can be a little difficult because you've had perhaps exposure in too many courses to some of these concepts, because there's different ways of looking at these transactions. And accounting, again, you usually look at those T accounts, and we don't talk about pluses and minuses. But for those of us who are purely economists, I propose, hopefully this is enough framework for us to use in talking about balance of payments. Let me know if you have any questions, and we'll have another video soon. Bye-bye.